Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me. I'm speaking of Ike Iossif, runs the website marketviews.tv. How you doing today, Ike?
I'm doing well, Mike. How about yourself?
Oh, I'm doing great, and thanks for taking the time to do this interview. You got a very fascinating and timely study that you've done about seasonality in the stock market, and we certainly have seen some wild swings in the market since the beginning of October, and the most consistent week for the market to go up all year historically has been Thanksgiving week, and it didn't happen, but now we're going up this week, so people kind of aren't worried about what happened the other week. But what are your thoughts on what's going on?
Early on in 1992, I started in 1990, the first week of January 1990. In 1992, the late Kennedy Gamut, who probably some of our older listeners remember because I used to interview him until he passed away. So in 1992, Kennedy Gamut gave me one of the greatest advices I have ever gotten in this business. He said to me, he said, look, you always have to consider yourself a student of the market. Yes, of course, as you get older, you have already learned lots of stuff, but you're still going to keep on learning. Because every good student knows that you have to take notes. And because if I can give you an advice is take notes. When you see something that looks to you odd, write it down. Have a diary, so to speak, out of the market action. Not only it will help your memory to retain what has been happening, but you will be able to compare things much easier. And actually, I do have notes going back to 1992. I mean, I probably can write maybe a book or two out of it. I'm saying this because my interest in seasonality came about because of the notes that I had taken. And what had happened was this. In October of 2000, people will remember that we had the bombing of USS Cole in Yemen on October 12th. On that day, the S&P was down about 2.7%, something like that. Then it had a strong bounce the next day. The bounce lasted another couple of days. It had a retest the following week, and then it started to rally. I noticed something really interesting. From October 18th until October 31st, I had watched on CNBC about 31, perhaps there were more. Those were the ones that I had gotten to watch. 31 commentaries about the market. 24 out of the 31, the commentator had used the argument that the bombing of USS Cole had marked the bottom, because we all know in October we get bottoms. And more importantly, November 1st was starting the most positive season of the year. So the market had only one way to go, that was up. It was interesting to me as I counted the same argument 24 times out of 31 commentaries.
So did the market go up?
It rallied a little further and then turned back down again. But in my own view, looking at the internals, looking at the momentum, looking at the price structure, the market looked bearish. But all truth be told, I couldn't remember in the 10 years that I had been in the business up to that point, a year during which the market was down between November and December. And in fact, I went back at the time and looked. And from 1990 until 2000, there was only 1 year that the market was down between November 1st and December 31st. That was 1994. 1994 actually was a flat year, was a consolidation year. The fact of the matter at the time was the last 10 years, the market indeed had been up 90% of the time between November and December. So you couldn't blame all these people using that argument. On the other hand, the technicals were staring at you and they were horrible. I thought it was worth noting, and I made a note of it. Let's see how things develop. Probably we're going to have a battle between positive seasonality and horrific technicals and the theoretic fundamentals, and let's see which one wins out. Well, as it turned out, the market went down, and I have the chart from that time. Now, the chart And so the S&P from September of 2000 until May 30th of 2001. We all know that the so-called positive season of the year is from November 1st until the end of May. That's why I have this blue rectangle. But during the positive period, there are 2 months that tend to be the most positive of all the months. That is November, December. Look what happened back then. The market started November at 1450, finished the year at 1320. It was down roughly about 7.5%. I made a note of that too, because I found it very interesting that during the most positive season of the year, the market, for the first time since I had been in the business, for the first time in 10 years, actually was down 7.5%. We move forward to 2007. In 2007, people will remember that actually the market topped in October, and then it started to turn down. After the top in October, if you listen to the commentary, and I'll give you the exact dates, that was between October 21st and November 5th, which is similar period than the other one in 2000. Once again, I counted the number of times commentators on CNBC and in other publications on the net were using the positive seasonality argument. That period, I counted 36, and out of those 36, 26 had used the positive seasonality argument.
It's a popular argument to make, obviously.
But I went back to my notes.
It usually happens, right?
Yeah, of course. Well, I went back to my notes because it reminded me of what I had observed back in 2000. It was eerily similar. And again, in 2007, the technicals looked horrific, and the fundamentals looked even worse. Look what happened. We started the month of November at 1508, ended up at 1468. Moreover, if you examine the entire positive period until the end of May, again, at the end of May, we were lower than where we were at the beginning of November. So not only the entire period failed, but also the 2 most positive months also failed. And let me bring you up to date and tell you what the data show for the last 29 years, going back to 1990. Since 1990, there have been only 6 incidents, 6 years, during which the S&P closed on December 31st lower than November 1st. Those 6 years were 1994, 2000, 2002, 2007, 2008, and 2015. Now, 1994 and 2015 were flat years, were consolidation years. The other 4 years, we were in full-blown bear markets. In fact, the sharp declines between November and December in 2000 and 2007, in hindsight, should have been a hint that the market climate had changed. So, what we can say for sure, based on fact, not opinion, is that the last 29 years, positive seasonality has worked 100% of the time in bull markets. It hasn't worked in consolidation periods or in bear markets. And let me show you the chart. This is the S&P going back to 1990. And these are the 6 years during, you can see the rectangles, during which seasonality did not hold. The first one was in 1994, and we can see we had the flat market and then a breakout. Then in 2000, in 2002, someone may say, oh, hang on, it worked in 2001. Yes, it did, but it worked coming out of the horrific decline we had after 9/11.
Right, that's right.
Okay, so if it had not been for that wonderful decline after 9/11, perhaps we wouldn't have had the result. And then again, here we go in 2007, 2008, and again in 2015.
So it was a significant decline in the first quarter of 2016. You know, the negative seasonality was a warning that there's downside risk here.
Well, if you look at where we're at now, let's see how December turns out. Because this is the S&P. We started the month of November at 2740. As we speak right now, which is about 11 o'clock, I believe, Eastern time, the S&P is about 2745. So it's pretty much flat. So I'll be looking forward, to see how December turns out. If the market closes at the end of December below 2714, I would take that seriously. Because as I said, there have been only 6 times in the past. 4 of them we were in bear markets, 2 of them were consolidation periods, but following that December decline, we had additional decline in January, and then the market turned around later. If positive seasonality holds, that would be a positive for the market, and would be an additional positive, because another thing is the market did hold at 2600. Now, when we spoke a few weeks ago, I had mentioned how the 2600 level is intermediate term support, and if it held, which I expected to hold at least the first time it was tested, it would be positive for the market. So if the S&P held at 2600, if December turns out to be positive, then I would say, as I said a few weeks ago when we did the other interview, then the market can continue higher into the first quarter of the year. My point is, then this is what I want to remember. Since 1990, there have been 6 incidents that market seasonality did not hold. 2 of them were consolidation years, and after the end of December, in January we had additional declines. The other 4, we were in full-blown bear markets. So if the market finishes below 2740, I would tame my optimism. If positive seasonality holds, that will be supportive that we can see higher prices into the next quarter.
Well, it's going to be interesting to see what happens. I know the seasonal pattern, when this rallies into the end of the year, usually there's just about always, except last week, or these other months that you point out, there's a rally Thanksgiving week, and then a small pullback for 1 or 2 weeks after that Thanksgiving week, and then a move into the end of the year. At the moment, we pulled back Thanksgiving, we're rallying this week, so the pattern's already a little bit different. If the rally this week ends before the end of the year, then we really are going to be in danger of turning down and breaking that 20 or ending the year below 2740. I think
what's important for people is to know the data,
right?
To know what they mean, and let's see how the month plays out, and then we'll go from there.
Yeah, that's good, and then we can draw some conclusions.
Yeah.
On New Year's and put things together and see where things stand. Well, thanks for talking with me.
Mike, thank you, and wish everybody happy holidays.